afternoon, friends, families, clients. I'm Colin Ketty, Managing Partner and Founder of Synergy Family Office. Today we'll be speaking with Kevin Dean from Newport Private Wealth. Synergy Family Office has had the pleasure of working with Newport for over the course of the last decade. As many of you know, the last decade has been quite the bull market that seems to be coming to an end. Uncertain market performance certainly makes us a little more hypersensitive and to returns as well as we tend to scrutinize our portfolios a little more at these times. Certainly the current circumstance is no exception, and no one certainly could have predicted it. So we'll be speaking with Kevin. Kevin is the Managing Director, Portfolio Manager at Newport Private Wealth and one of the senior members on the investment committee. Kevin has his CFA, and he also holds the designation of International Wealth Manager. Kevin, thank you for joining us today and sharing your time and insights of what's been going on in the market currently and over the last few months. For some of our viewers who are less familiar with who Newport is, Kevin, could you just take a minute and give us a little bit of an overview of what you do at Newport and what Newport's all about?
Sure. Yeah. Thank you, Colin. Thanks for having me. So Newport is a private wealth management firm. We have clients across Canada. We provide our clients access to an institutional style pension portfolio. So our portfolios mix both public securities and private assets. And we do this by utilizing 100% third-party managers. So our investment committee selects and monitors all of the managers that we work with across many different asset classes, including both public stock and bond markets, as well as other asset classes such as private debt, commercial mortgages, directly held real estate, infrastructure, and private equity.
Fantastic. So, Kevin, I'm going to jump right in here and try and hit you with some of the hard questions. With a big sell-off here, what did Newport do prior to this sell-off? How did you guys position yourself months in advance for this?
Yeah, so anyone that had really followed any of our commentary in 2019, especially in the latter half of 2019, we were getting increasingly nervous about the valuations of the markets. 2019 had very good equity market returns, mainly from multiple expansion, whereas there was very weak corporate earnings growth, very weak economic growth prospects. And all of this had us concerned. And for a medium risk portfolio, we ended the year with about 40% public equity exposure and nearly 18% in cash. Now, we had no idea a global pandemic was on the way, and it was purely a call on the valuation of markets and prospects going forward. But that obviously did a great job of limiting the downside for our portfolios and also setting us up well to start to take advantage of it.
I guess one of the questions is what do you make of the markets right now? We've had down as low as 35. Certainly, there's been a bit of a rebound, but it really doesn't seem like the market is connected as far as the economy is concerned. So, Kevin, why is this happening? What are you guys seeing?
It has been a very interesting start to 2020, for sure, in terms of how rapid the decline in the markets were in late February and March. And then we've had this significant rebound off the lows over the past 7 or 8 weeks. In days when we were having unemployment statistics announced and U.S. unemployment, rising to over 15%, we were also having the Dow and S&P 500 up a couple percent on the day. At the moment, it very much seems like investors are looking past, the fact that Q1 and Q2 have been so drastic in terms of the drop in GDP and economic production. For any client that might have a very long-term time horizon, has no cash needs off their portfolio, they certainly can look at this as an opportunity and take advantage of weak days in a row, having weeks of a downward trend in the markets and building positions for the longer term. The rally that we've had of recently, for any client that's on the opposite end of the spectrum, they should be looking at, did March catch them by surprise? Did it panic sort of their positioning in their portfolio? And and they should really look at the liquidity they have and do they have enough cash to fund their lifestyle over the next couple of years. And if the answer is no, then perhaps, this rally we've had of recently, would be a good opportune time to make sure that they are positioned correctly and that they have enough sources of income. And when I say sources of income, interest rates are quite low, and some dividends have been, cut or temporarily suspended. And ensuring that a portfolio of other sources of income, mortgages paying interest, rent collections from apartment buildings, private debt portfolios, things like that, can help diversify the income stream. And clients should be talking to their advisors about that and making sure that they're properly protected and properly set up to weather a potentially longer economic recovery here that we may have ahead of us.
Okay, I think that's very valid points, and certainly something for people to think about, as you mentioned. Making sure you have that income for a couple of years. That's we're not necessarily talking about a few months of safety net. We're talking about potential long-term cash flow. So great point. So right now in the market, and again, very unprecedented times. What are you guys identifying as? Here's what we see as big risk.
I think currently we feel there's certainly a risk that the markets may have baked in some overly optimistic projections for what we have in the remainder of 2020. There's no doubt that the media headlines around potential vaccines and phase 1 trials, economic reopenings, some businesses, restaurants, doctors, dental offices, these types of things starting to open up. And we certainly haven't had the most dire predictions around the healthcare industry and the run on hospitals and things of that nature come to fruition. So I think in general, people are feeling a little bit better. And we're concerned that might be too optimistic. We're concerned at the what we feel a realistic picture of the economic recovery may be, both in its strength and how quickly that may come to fruition. And we're concerned about really the level of earnings that businesses may get back to. We think companies are going to have higher expenses to figure out how to operate in this post-COVID sort of new world that we're going back to. And we're concerned that right now, general consensus and view is that the recovery is going to be a little stronger and earnings will come back a little quicker than we think may be the case. So with that being said, we think it remains prudent to, have dry powder, have higher levels of cash right now. There's no doubt that, there's a ton of fiscal and monetary stimulus happening, and central banks and governments have, stepped up and said they're going to be there to support. But there will be a finite resource at the end of the day, and we feel that the risk here is that this may take longer than people think, and people need to be prepared for that.
Fair enough. So would it be safe to say, in respect to this dry powder, does it stay in the war chest for later? Do you see any opportunities to deploy some of this dry powder you talk about, Kevin?
Absolutely. And I mean, some of the opportunities have presented themselves. I mean, the best opportunities certainly were in March. And we did take a portion of our cash reserves, and we spent over $100 million in some of the areas that we saw some of the best opportunities, which included investment grade credit, high yield bonds, some of the dividend paying equity sectors, as well as REITs. And I think in all of those asset classes, there was a lot of baby out with the bathwater, where there was serious and concerns about, a number of them, shopping center related REITs, retail oriented REITs, and things of that nature. But there was lots of other companies that saw their stock prices suffer along with it. And we saw both investment grade and high yield bond spreads widen out to levels of yields that we haven't seen in years. And in all those areas, we, for a long time, we felt were too expensive, that the risk return ratio of how much you were being paid in terms of the yield for the level of risk you were taking just didn't make sense. And in a number of those areas, it does make sense to us now. and we'll look to continue to deploy if we get another opportunity to do so. On the private side of things, you need to be patient. It's going to take a little longer in the private markets for some of the weakness and the cracks really to show. They don't react in terms of the valuations quite as quickly as obviously the public markets do. And we think because of the longevity that this recovery will take, there will be businesses that come into financing issues going forward, liquidity issues. There will be distressed sellers of illiquid alternative investments, including real estate, including private debt portfolios, and private equity investments. We've currently committed to one distressed debt lender, which will focus on helping companies that get into distress in terms of their corporate debt and restructuring that debt and need to look to raise cash or raise equity and cash to do so. And we do think that there's going to be good opportunity going forward on the real estate side and private equity side, including private equity secondaries, where you would buy a private equity LP interest from somebody that is looking to get liquidity. And we do think that there will be more sellers that are not selling just because of diversification and asset mix reasons, but because of liquidity reasons. And that's where you can start to take advantage and deploy capital at levels that should suit you very well over the longer term.
Okay, excellent. And that really speaks to, one of the things that we've been talking about here really since the onset is trying to, I guess there's two ways to approach this. Nobody likes bad news. I mean, you have to deal with these things as they come and be able to react and be able to change. We've been sort of touting this line, versus simply riding it out. You really need to ride it up. Look for what those opportunities are, act on the opportunities, be ready for future opportunities. I get a real sense that's what you're doing at Newport. It's not simply just, wait and see and watch. You guys are reacting. You are making decisions that you feel are beneficial on the go forward. And that's fantastic. And I think that's what everybody appreciates, in dealing with your group is just that level of involvement in detail, as the market cycles. I mean, this is, certainly not the first trip to the ball game for you guys as far as going through this. I mean, it's happened before. They're always different. Pandemic is a bit of a stretch. It's certainly nothing that we've seen, but I think the anticipation, as I say, it was a long bull market. It was a matter of time. Something was going to happen. This just happens to be the straw that broke the camel's back, as they say. But again, Kevin, thank you so much. Ongoing, continue great work that you guys are doing there. Much appreciated.
Thanks for having me, Colin.
If anybody has any additional questions for Kevin, please get in touch with me. I'll make sure that you can speak to Kevin directly. And again, fantastic. Thank you so much. And thanks for tuning in.